Earnings can often tell only half the story. When a major shift unfolds within a company, numbers alone may not explain the deeper transformation. For First-Gen Corp, this quarter marks a bold step, a move away from gas, with the financial implications becoming both visible and consequential. Consolidated net income fell nearly 16%, and recurring earnings dropped even further. These declines point to more than accounting changes. They signal the real cost of repositioning. Yet, underneath the headline numbers, revenue grew sharply, driven by robust geothermal, wind, solar output, and strong results from the Pantabangan-Maziwe hydro complex. Operating profits increased, but margins narrowed as costs outpaced the growth in sales. Heavy investments in drilling, staffing, transmission, and new projects have begun to weigh on earnings, leaving each peso of revenue under pressure. Fundamentally, cash flow has become a central concern. Free cash turned deeply negative, while cash reserves almost halved. These shifts are tied to future-oriented spending, stock subscriptions, acquisitions, and loan prepayments. No dividends were declared in the first quarter, raising questions for shareholders used to reliable payouts. There are broader ripple effects. First-Gen's dividend restraint affects its parent entities, tightening financial flexibility across the Lopez holding chain. The recent sale of a majority stake in the gas business means ongoing cash flows from gas are no longer consolidated, now appearing as reduced equity earnings, and only 40% of former gas profits return to First-Gen. Platform performance is mixed. Energy Development Corp delivered strong growth and net income. Hydro assets outperformed as well, but Kaseknan faced challenges, with falling revenues and a net loss driven by lower water inflows and higher costs. Liquidity ratios, while adequate, are trending downward, underscoring the risks amid heavier capital spending. The strategic pivot is unmistakable. First-Gen is committing billions to pumped hydro, battery storage, and other growth assets. These investments are necessary as the Philippine grid transitions to more renewable power, but they require patience before new assets generate returns. Significant exposure remains to merchant power price swings, despite higher contracted capacity. Ultimately, First-Gen's story is twofold. Renewables are becoming the core, bringing promise and potential. But the transition is capital-intensive, compressing margins and restraining cash returns. For investors, the opportunity lies in long-duration growth. For those focused on dividends or near-term payouts, patience may be required. The green transition is underway, demanding both conviction and a willingness to wait for the rewards ahead.